Welcome back to the Deep Dive. Today, we're really taking an exhaustive look into one of the most, well, stunning financial stories of the decade, the historic surge in gold prices.
It really is something else.
Yeah, and we aren't just, summarizing headlines here. We are diving deep into the source materials, really looking at the conviction and, frankly, maybe the fear. That seems to be driving institutional money into this asset class.
At a pace we really haven't seen in generations. It's quite remarkable.
So we're going to try and unpack this whole complex landscape. Our aim,
Yeah.
understand the underlying macroeconomic forces,
Yeah.
the debt, the inflation, the currency risk, and crucially, what the world's top financial minds are recommending you, the listener, do right now. Okay, let's unpack this. Let's start with just the sheer magnitude of this movement. The price was recently soaring near, what was it, an astounding $3,700 per ounce.
Right, $3,700. And, that price point, it only tells half the story.
Right.
To really grasp the significance, you have to look at the performance curve. Gold has surged nearly 40% this year alone. 40%.
Wow.
And when we talk about historical context, that percentage gain is, well, it's monumental. We have to rewind the clock all the way back to 1979.
1979.
An era defined by, financial turmoil, staggering inflation, to find an annual increase this substantial. We are basically watching financial history being written right now.
That comparison to 1979 is instantly, well, it's chilling, isn't it?
Yeah.
Because that decade, it was characterized by oil shocks, the breakdown of Bretton Woods, the stagflation crisis.
Exactly. Serious upheaval.
But here's the central paradox that really grabbed our attention in the sources we looked at. Even with this historic 40% run,
Yeah.
and despite the natural temptation for profit-taking, and, some investors are realizing gains.
Sure, that makes sense.
They're citing the Federal Reserve's cautious easing cycle as the perfect moment to monetize their position.
Right.
Despite all that, absolutely no mainstream analyst is suggesting investors reduce their exposure. None. They're not telling clients to take their foot off the gas.
And that lack of recommendation to, reduce exposure, that is maybe the most important data point we found.
Really? Why?
Because it signals this isn't just some speculative spike or, a momentum trade. We seem to be witnessing a fundamental shift in how large capital views gold.
A fundamental shift. How so?
Well, it's acting less like a traditional commodity, responding to industrial supply and demand, and much more like a necessary, maybe even non-negotiable hedge against major deep-seated systemic risks.
Systemic risks.
Yeah, risks that kind of transcend typical market cycles. They're essentially buying insurance. And the premium on that insurance is climbing very, very rapidly.
So our mission today, then, is to explore the specific strategies behind this defensive posture.
Yeah.
I need to look at mandates coming out of institutions like Societe Generale, Morgan Stanley.
Right, the big player.
And then we absolutely must pinpoint the critical macroeconomic threats, the scale of global debt, the unique nature of modern inflation risk, and this anxiety around monetary policy independence.
All the things fueling this seemingly inexhaustible institutional demand.
Exactly. Okay, let's nail down those hard facts again just to really cement the scale of this rally. We have gold hovering near $3,700 per ounce.
Right, around $3,700.
Having climbed nearly 40% year-to-date in 2025.
40%, yeah.
Which makes it the strongest annual performance observed since 1979.
Since 1979. And let's just spend a moment on that benchmark because I think it offers crucial context.
Okay.
That period, the late 70s, it was defined by chronic high inflation, political instability, things that severely eroded the purchasing power of fiat currencies.
Right, I remember the stories.
Yeah.
Or, well, I've read about them.
Exactly. Now, today's situation, it has similar characteristics maybe, but different mechanisms drive them.
Different mechanisms.
Yeah. In the late 70s, it was largely external shocks like the oil crisis. Today, the primary engine of instability feels more internal.
Internal how?
Massive, chronic, compounding government debt levels, that's the big one,
Okay.
combined with, geopolitical fragmentation. The fact that the gold market is reacting with the same kind of intensity suggests that investors believe the structural instability today is comparable to, or maybe even greater than, the volatility we saw 40 years ago after the oil shock.
That's a heavy thought. Greater than the 70s.
It is, and it's essential, like you said, to acknowledge the immediate volatility we've seen.
Right, the profit taking.
Exactly. It's entirely rational for investors who've enjoyed a 40% jump to realize some of those gains.
Sure, lock it in.
And they're using the Fed's recent moves, this cautious return to the easing cycle, as the specific moment, the excuse maybe, to de-risk a portion of their holdings.
Makes sense on the surface.
But, and this is where the critical analysis comes in, while that profit-taking is normal, the underlying structural conviction seems unshakable.
Because no one's saying sell.
Precisely. We noted that not a single analyst in our sources recommended reducing exposure. Not one.
That is a powerful signal.
It really is. Usually after such a parabolic move like this, you'd expect to see a significant split in forecasts. Lots of experts calling for a necessary correction. Right?
Yeah, absolutely. Reversion to the mean, all that.
But the fact that the consensus is to maintain or even potentially increase exposure, that tells you something important.
What does it tell you?
It tells you the experts believe the underlying fundamental drivers, these macro threats we're about to detail, are far more dangerous than any temporary impact from short-term Fed actions.
So if you're a portfolio manager, you've seen gold went up 40%. Your instinct is usually, okay, sell a bit, rebalance.
Right. Standard practice. Portfolio management 101.
The very fact that they seem to be resisting this fundamental principle, it shows this overwhelming defensive posture.
It does. They seem so concerned about what might be coming down the pike.
Like what?
Currency debasement, maybe escalating conflict, or a full-blown debt crisis.
Okay.
That they're willing to ignore potential short-term valuation risks just to hold on to that insurance policy.
Wow. So they're looking past the next earnings report.
Way past it. They're focusing instead on multi-year threats. Threats to the stability of the entire global financial architecture.
Okay.
And when the people running the world's largest pools of capital signal that level of deep structural concern, it kind of shifts gold, doesn't it? From being just an attractive commodity to being an essential defensive position, a must-have.
Okay, so this overwhelming consensus to maintain exposure, it translates into very specific, pretty high-stakes investor strategies.
Right.
Which brings us to the mandates being issued by these institutional giants.
Right.
If the market leaders all agree, basically, keep your foot on the gas, what does that actually mean for the allocation mandates they issue?
Well, the required allocations are, frankly, remarkably aggressive when you view them through a historical lens.
Aggressive how?
Let's look first at Société Générale, the major French financial institution.
Okay, so Soygen, what are they doing?
They have explicitly increased their holding. They've taken a maximum 10% position in gold.
Maximum 10%.
Within their multi-asset portfolio strategy, a max 10% in gold.
Okay, let's define maximum position for listeners. This isn't just a casual punt, right?
Not at all. This represents the highest allocation they are institutionally comfortable assigning to a single, non-traditional asset class. It's based on their internal risk management models.
Right.
So for a major global bank like Sogen to dedicate a full 10th of its strategy to gold, that's a statement.
It sounds like a statement of extraordinary conviction, like they really believe in its hedging necessity.
Exactly. And this 10% figure, it isn't an outlier. It feels like it's being set as the new standard floor.
The floor?
Yeah. Look at billionaire Ray Dalio, founder of Bridgewater. Huge name, known for his macro insight.
Oh, yeah. Okay. What's he saying?
He stated publicly, I think it was at the Future China Global Forum 2025, that all investors, big institutions, individuals alike, should hold at least 10% of their portfolio in gold.
At least 10%. So, wait, we have a major European bank setting the ceiling at 10%?
Their max.
And arguably the world's most influential hedge fund managers setting the floor at 10%.
That's right.
That creates this powerful, almost unanimous mandate for gold as a core necessary part of a portfolio.
It really does.
But let me ask you this. Isn't a 10% target, if everyone starts adopting it, isn't that potentially creating the next institutional herd?
The herd behavior question. It's a fair point.
Are these giant players kind of creating a bubble they themselves are trying to hedge against? Or is this just, sound risk management?
Look, it's an important question. Any concentrated trade always carries risk, right?
Sure.
But the consensus here seems to stem more from fear, I think, than from greedy speculation.
Fear, not greed.
These institutions aren't really chasing immediate returns here. They're attempting to diversify away from systematic fiat currency risk they see as rising dramatically.
Right.
So if everyone believes the house is, structurally unsound, then everyone buying fire insurance at the same time isn't necessarily a bubble in insurance.
Ah, good analogy.
It's just prudent preparation. Now, the risk is that the price of that insurance, the gold price, rises too quickly.
Okay,
But the risk of not holding the insurance is clearly being seen as much, much greater by these players.
got it. Okay, so moving beyond just the simple 10% mandate, we also saw evidence in the sources about how gold is being formally integrated into traditional asset allocation models.
Yes, that's another key development.
Morgan Stanley's chief investment officer, Mike Wilson.
Right.
His insights are tracked globally.
Right, Mike Wilson, very influential.
He recommends a specific 60-20-20 portfolio structure. What's that about?
Well, the standard portfolio advice for decades was the 60-40 split.
Yeah, 60% equities, 40% bonds.
Exactly. Wilson's recommendation alters the defensive side, the 40%, quite significantly.
Oh, so?
He keeps the 60% in equities, but then he breaks down the remaining 40% like this. 20% in traditional fixed income, so bonds, and then another 20% dedicated explicitly to hedging against volatility and systemic risk.
A dedicated 20% hedge.
Yes. And crucially, his strategy specifically advises balancing gold and sovereign bonds within that. Well, within the total 40% non-equity portion. But that 20% hedge is key.
Wow. Okay, that is a profound strategic shift. It kind of elevates gold from being just an alternative asset or a marginal inflation play and places it squarely in the core protective component category, right alongside government debt.
Precisely. It acknowledges that traditional fixed income, traditional alone, might not provide adequate protection anymore.
Not against the modern combination of, well, massive debt and potential monetary policy failure.
You got it. It speaks directly to that fear of debasement of fiat currency. Think about it. Sovereign bonds promise to pay you back in dollars or euros or yen, right?
Sure.
But if central banks are forced to inflate the currency supply, maybe to finance massive government debt,
Which we'll get to.
right, then the value of those dollars or euros or yen when you finally receive them back is severely diminished.
Your purchasing power is eroded.
Exactly. Gold, which stands outside that whole system, becomes necessary to mitigate that specific risk of debasement. It's the ultimate zero counterparty risk asset. There's no government promise attached, just the metal itself.
Zero counterparty risk. Okay. Now, let's contextualize the potential market impact of these recommendations. If these huge institutions are mandating, say, a 10% allocation, how much gold is actually held globally right now in portfolios?
Well, the current figures really illustrate the vast potential for upward movement. It's quite stark. Gold reserves currently make up only about 2% of total global financial assets.
2%. Just 2.
Just 2%.
That figure is staggering, especially when you consider the trillions and trillions managed by these institutions.
It is.
So if institutional adoption simply moves from that 2% base to meet Dalio's minimum recommendation of 10%,
Yeah?
that implies a potential, five-fold increase in capital flowing into the gold market?
Potentially, yes. The simple physics of supply and demand suggests that the continued upward price pressure, if that capital actually starts flowing in earnest, could be astronomical.
It certainly confirms that despite this huge 40% rally we've already seen, this market is maybe nowhere near saturated yet.
Precisely. The vast majority of global assets are still structured based on models from, a pre-2008 world, or certainly a pre-hyperdebt era. Models that completely ignore the current expert consensus on systemic risk mitigation.
So the institutional fear, it hasn't fully translated into widespread global asset reallocation yet.
Not even close, which, as you say, provides immense potential energy for this rally to continue.
Oh, okay, so the strategies are aggressive, clearly. But the question remains, what are they so afraid of? Now we shift to the why in Section 3. The primary motivation seems to be the need to protect wealth in a very volatile environment.
That's the core driver, yes. Wealth preservation.
And the central risk, according to the sources, is inflation. Specifically, inflation driven by rampant, growing government debt.
Yeah, that connection is key. Gold is often viewed as the ultimate store of value precisely because it cannot be printed into oblivion by, desperate governments.
Right. Can't print more gold.
Exactly. So when governments appear fiscally reckless, gold tends to shine. And the sheer magnitude of the current U.S. debt picture is providing the most immediate and maybe the most intense fuel for this gold rally.
Okay, let's anchor this with the figures again. They are pretty alarming. The U.S. budget deficit has grown by an astonishing $2 trillion this year alone.
$2 trillion.
In 1 year. It's hard to comprehend.
That rate of annual overspending is simply unsustainable in the long term without some kind of significant economic consequence, isn't it?
Absolutely. And that $2 trillion annual deficit, it just compounds the core problem exponentially. The total U.S. national debt now exceeds $37 trillion.
$37 trillion. And for the listener, the mechanism here is really crucial to understand. Debt of this magnitude, $37 trillion, creates immense pressure on the Federal Reserve.
How so?
Well, think about it. If the Fed fights inflation aggressively by keeping interest rates high,
Which is its traditional job.
right, then the interest payments on that $37 trillion debt become fiscally crippling for the government. Just interest cost balloons.
Okay, so high rates make the debt unaffordable.
Essentially, yes. This forces the government, implicitly or explicitly, to pressure the central bank to keep rates low, a process sometimes called financial repression.
Financial repression.
Or worse, it leads to the temptation for the government or the central bank to simply inflate the currency supply,
Print money.
to dilute the real value of the debt, make it easier to pay back in cheaper dollars.
And investors are betting on that latter scenario, the inflation scenario.
It seems many are, yes. They're betting that faced with the choice between fiscal pain and inflation, the authorities will ultimately choose inflation. And gold is the classic hedge against that outcome.
The sheer size of that $37 trillion debt figure, it fundamentally changes the role of the central bank, doesn't it?
It really does.
The political and fiscal constraints become so immense that the Fed's ability to act truly independently is, well, it's heavily compromised.
Exactly. Which we'll talk about more in the next section regarding Fed independence.
Okay.
And the sources we looked at are very clear. This high level of indebtedness, it's not consigned to the U.S.
Right. It's a global problem.
The sources explicitly note that the whole world is sinking under growing debt levels.
It's all world.
Yeah. While the U.S. figures are the largest and maybe the most immediate concern because of the dollar's global reserve status, the general systemic risk is widespread. Nearly every major economy is wrestling with similar debt-fueled inflationary pressures and political constraints.
So this global debt overload, it kind of necessitates an asset that's universally accepted and stands completely outside traditional fiat risk. Which brings us back to gold.
Exactly. Which is why gold is performing so well across pretty much every major financial jurisdiction. It's become a kind of universal currency barometer, a measure of distrust in all fiat systems.
And we have concrete evidence of this global hedging demand, right?
We do. Gold continues to hit record highs relative to all major global currencies.
All of them, not just the U.S. dollar.
Not just the dollar. This is crucial. It's not simply a U.S. dollar weakness story, although that certainly plays a role. It's fundamentally a global fiat currency weakness story.
An indictment of sovereign fiscal policy across the developed world, essentially.
Well, that's a good way to put it, yeah.
Which specific currencies did the sources mention gold setting new highs against?
Well, the list is pretty comprehensive. The Canadian dollar, the British pound, the euro, the Japanese yen, and the Australian dollar.
Wow. Pound, euro, yen.
Yes. When an asset achieves all-time highs simultaneously against currencies from 5 major distinct global economies, it really confirms that the problem is structural and global rather than just regional or temporary.
And the scale of the currency debasement in some of these smaller, though still major economies is quite striking. We saw that specific example with the Canadian dollar.
Yes, that was remarkable. The gold price quoted against the Canadian dollar is currently over $5,000 per ounce.
5,000 Canadian dollars for 1 ounce of gold.
Right. It provides a really tangible metric for the erosion of purchasing power, even in a country like Canada, which is typically seen as having a highly respected, stable economy.
It acts as a clear siren call then.
I think so. When debt levels climb this high and interest rates are potentially manipulated or suppressed to manage that debt, gold naturally steps in as the non-sovereign check against that monetary risk.
Okay, moving into Section 4 now. We need to address the second major pillar driving this institutional gold demand. And that's the deep-seated concern that the Federal Reserve, the U.S. Central Bank, may be losing its monetary policy independence.
Right. This ties directly back to the debt issue we just discussed.
So alongside that growing debt, investors are actively seeking alternatives to the U.S. dollar, specifically because of this potential erosion of central bank credibility.
Exactly. The fear is rooted in the current political and fiscal realities we've been talking about. On the surface, you look at the Fed, and they've planned a relatively mild easing path. suggesting gradual rate cuts.
Okay, that's the official line. Mild easing.
That's the official line. But the market looks at the scale of that $37 trillion debt, and it asks a fundamental question. Will the Fed actually be allowed to maintain a mild, gradual course if that debt burden really starts to crush government budgets? Or will the political pressure become too intense?
And this concern leads many analysts to project, well, the potential for a pretty severe policy shift down the line.
That's right.
Seeing the potential for much more aggressive cuts than what the Fed is currently projecting,
Yeah.
especially maybe heading into 2026.
Yes, more aggressive cuts, perhaps sooner than expected. And 2026 is relevant, partly because the sources we saw reference the potential for future appointments to the Federal Reserve Board.
Ah, the political angle.
Well, specifically in light of the upcoming U.S. election cycle, regardless of the outcome. The market seems to feel that new appointees, potentially from either side, might favor a more aggressively dovish stance.
Prioritizing what? Government spending and debt financing over strictly fighting inflation.
That's the fear, thereby undermining the Fed's perceived independence.
And for the listener, just to be clear, this is why we have to treat this topic with neutrality.
Absolutely.
We're reporting on the analyst reaction and market perception of potential policy outcomes. We're not endorsing any political viewpoint here.
Correct. It's about how markets interpret the political constraints on monetary policy.
Okay, so the immediate indicator we have of these internal tensions, these pressures, is the dissent we saw during the recent Wednesday monetary policy decision.
Right. That dissent was noted in the sources. It shows the pressure is already mounting within the Fed's own structure.
And that internal dissent, it acts as a major red flag for institutions watching closely.
Right. Absolutely. The dissenting vote came from Stephen Mirren. He's a relatively recent appointee. And he advocated for a significantly larger 50 basis point interest rate cut.
50 basis points. Wow, okay. That's not mild.
No, 0.5%. That's a major, aggressively accommodative move, especially compared to the consensus view for a smaller cut or none at all.
So when one member is pushing for a cut more than double the size of the consensus, what does that signal to the market?
It signals that there's a strong internal push, or at least a vocal one, to prioritize easing financial conditions.
Likely to help service the immense U.S. debt burden.
That's the market interpretation, yes. Prioritizing that over ensuring price stability, which is, the Fed's traditional mandate.
And that is the implication that immediately boosts gold demand.
Precisely. Investors worry that the Fed is no longer strictly focused on its historical dual mandate, maximum employment and price stability, but perhaps on an unspoken triple mandate, which now includes fiscal stability.
Fiscal stability meaning making sure the U.S. government can afford its debt payments.
Essentially, yes. And if the market perceives that the Fed is sacrificing inflation control for debt financing, it confirms the fear that monetary policy is no longer truly independent. It's become subservient to fiscal needs.
And for global investors who rely on the dollar as the world's reserve currency.
A politicized Fed means a riskier dollar, a potentially more inflationary dollar.
Which drives them straight to gold, the non-fiat, non-political alternative.
You got it.
So gold is essentially trading on this risk premium, a premium associated with anticipated monetary policy failure and the possible political capture of the U.S. central bank.
I think that's a very accurate way to describe it. It's fundamentally a bet against the long-term stability of the dollar's value, almost regardless of the current short-term economic data points.
They're positioning themselves not for what the Fed says it will do.
Exactly, but for what they believe the Fed will be forced to do eventually by the crushing weight of that $37 trillion debt.
Okay, so we've established that institutional conviction seems sky high. The fear is palpable. Yet, when we look at certain public metrics, we find this massive counterintuitive fact. Which brings us to the ETF disconnect in Section 5.
Ah, yes, the ETF situation. It's quite puzzling on the surface, despite gold trading at these record high prices near $3,700. World Gold Council data shows that global assets in gold-backed exchange-traded funds, ETFs, the most common way for many investors to get exposure, they remain significantly below the record levels seen back in 2020.
Below 2020 levels. That is genuinely shocking. Gold's at all-time highs now, yet the primary, easily accessible vehicle for retail and broad-based investor participation, the ETF hasn't even surpassed its peak demand from 5 years ago.
Correct. Significantly below those peaks.
Yeah. What does this tell us? Who is doing the buying if it's not flooding into ETFs? What's the nature of the current buying pressure?
Well, it strongly suggests the price rally is being driven by powerful but relatively less visible forces.
Less visible how?
The primary buying pressure is likely coming from, first, Central banks. We know many are diversifying reserves away from the dollar.
Okay, central banks. Makes sense. Who else?
Second, massive institutional direct holdings. Think of the Societe Generale 10% commitment that might not all be via public ETFs.
Right. Direct, maybe physical holdings or specialized contracts.
Exactly. And third, high net worth private investors. They often buy physical metal directly or use customized investment vehicles outside the main public ETF market.
So the big money, the sophisticated money, is moving quietly and strategically. Is that the idea?
That seems to be the implication, yes.
Okay, so the price is being dictated more by sophisticated fear, maybe, than by mass retail enthusiasm or,
Yeah,
FOMO fear of missing out.
that appears to be the case right now.
And if the current record price is being set without the full mobilization of retail capital via ETFs, that implies there's still immense untapped demand potentially sitting on the sidelines.
It certainly suggests that, yes.
What indicators might those retail investors be waiting for before they jump back in?
That's the million-dollar question, isn't it? Retail investors often, historically, wait for more concrete confirmation of major crises, things that really validate the need for a hedge like gold.
Like what kind of confirmation?
They might be waiting for, say, a definitive, sharp stock market correction, or an explicit confirmation of a deep recession, not just talk about one,
Okay.
or perhaps undeniable evidence that inflation is becoming structurally embedded again and truly uncontrollable by the Fed.
So once they see that kind of clear confirmation and the gold price is still holding high,
Exactly. That fear could translate into a massive influx of capital back into those ETFs.
potentially guiding the next, maybe even more aggressive leg of this rally.
That's the potential scenario, yes. A second wave of demand.
Okay, looking forward then. Is this investment appetite, this institutional demand, expected to persist, even after such a huge run-up already?
Well, the consensus among the analysts cited in our sources seems firm. They expect investment demand for gold to persist and not vanish anytime soon.
Why? Because the underlying problems aren't going away.
Precisely. The underlying macro drivers, the debt, the currency risk, the policy concerns, they seem to be only escalating, not dissipating. So the rationale for holding gold remains, or even grows stronger.
And this leads directly to predictions about market behavior, right? What happens when we inevitably see a minor correction or a price dip?
The broad expectation is that any market dip or pullback will be quickly bought up.
Bought quickly. Why?
Because the institutional mandate, as we discussed, seems to be to maintain or reach that 10% allocation target. So for institutions that are still underweight gold, a price dip isn't a warning sign to sell.
It's a buying opportunity.
Exactly. It's an opportunity to acquire the necessary insurance at a better cost basis to build up to their target allocation.
In the sources, they validate this expectation with historical context, showing this isn't just theoretical behavior.
They do. They confirm that this buy-the-dip trend has been evident and pretty persistent over the last 3 years.
30 years.
Yeah. Every time gold has had a significant correction during that period, substantial capital has flowed in relatively quickly to defend that floor, which just reinforces the market's conviction that the systemic risks are perceived as increasing, not decreasing, over time. #tag outro.
Well, this has been a truly fascinating deep dive into the conviction, maybe the fear, driving this incredible gold market. For you, the listener, integrating all these complex facts into a cohesive understanding of global risk is really the goal here.
Absolutely.
So what does this all mean? Let's try and synthesize the 3 most important nuggets of knowledge from our sources today.
Okay. First, I'd say gold's rally, the best we've seen since 1979, seems driven by structural, fundamental macro concerns, primarily escalating global debt and related inflation fears. It's not just speculative fervor, and that fundamentally changes the outlook for the asset.
Right, it's not a bubble in the traditional sense, maybe. Nugget 1. Driven by fundamentals. Okay, what's number 2?
Second, the expert strategies coming out of global financial powerhouses like Sagan, like Dalio, like Morgan Stanley. They are mandating significant minimum 10% portfolio allocations in some cases. This cements gold's role not as an alternative, but as a core defensive necessity against potential currency debasement, sitting right alongside sovereign bonds in some framework.
Okay, nugget 2. Experts demand minimum 10% allocation as a core hedge. Got it. And third,
This rally is a direct response to widespread global financial anxiety. That's confirmed by gold setting simultaneous record highs against all major global currencies, not just the dollar.
Right.
And it's being driven by that escalating debt, now over $37 trillion in the U.S. alone, and mounting concerns about U.S. dollar stability and, critically, Federal Reserve independence.
Okay. Nugget 3. Global debt and Fed worries make gold a universal barometer of fiat distrust. Excellent summary. It really paints a picture of institutions placing, well, maximum bets against the long-term stability of the global fiat system.
It certainly looks that way.
Now, we've established that this institutional demand is exceptionally high, driving the price to these records. But we also noted that really counterintuitive fact that ETF assets are low, significantly below their 2020 peak,
Yes, that disconnect is key.
which raises a critical, maybe provocative final question for you, the listener, to mull over as you process all this information.
Which is?
If the current record-breaking gold price, near $3,700, is being established without the full engagement of retail and broad-based ETF investment, what happens to the price dynamics if that massive pool of retail capital eventually does return to the market?
Right. If they're driven back in by either a confirmed recession or clear monetary policy erosion.
What happens when they finally catch up and decide they need to participate in this systemic hedge too?
That secondary wave of demand, potentially from the very investors currently under-allocated via ETFs, that's the great unknown, isn't it? Looming over this market.
Something to think about. Thanks for joining us on the Deep Dive.